All right, welcome to Talk Tickers. Today we're digging into the Q4 2025 earnings for Cathay General Bancorp, ticker CATY. Now, on the surface, this was a fantastic report, but the way the market reacted, well, that tells a much more complicated story.
Okay, let's just dive right in. Cathay beat estimates on earnings and on revenue. Normally, that's a recipe for a pop in the stock, but not this time. The stock actually sold off. So the central question for us today is pretty simple. What did the market see that wasn't in those shiny headline numbers?
So first things first, let's just set the scene by looking at the headline beat versus what the stock's tape actually showed. This is really where the disconnect begins.
So Cathay comes out with GAAP earnings per share of $1.33. Now you gotta understand, this was a solid beat. It came in a full 10 cents above what analysts were expecting. That's a nice 8% upside surprise. And it wasn't just earnings, right? The revenue story was just as strong. They pulled in nearly $223 million, easily beating the consensus estimate of about $212 million. We're talking a 5% beat, and almost 19% growth over last year.
And here's the punchline. Here is the market's verdict. Despite those strong numbers, the stock dropped 3% the day after the call. This tells you everything you need to know. It says that investors were looking straight past the rearview mirror and were focusing entirely on the road ahead.
So, to really get why the market had this reaction, we first have to appreciate what drove this strong quarter in the first place. Because, let's be clear, on a fundamental level, the results were genuinely solid. A huge piece of the puzzle was the expansion of their net interest margin, or NIM, the core measure of a bank's profitability. It actually ticked up to 3.36%, which they said was driven by a lower cost of funds. In this kind of rate environment, any NIM expansion is a significant win. Then you look at their credit quality, which actually improved quite a bit. The money they set aside for potentially bad loans, that dropped by over $11 million from the last quarter. And the percentage of non-performing loans also went down. That signals a really healthy and well-managed loan book.
And on top of that strong performance, management was also busy returning capital to shareholders. They bought back almost $52 million worth of their own stock in the fourth quarter. That shows a lot of confidence in the company's own valuation.
So, you've got this great quarter in the books. Naturally, all eyes on the call turn to the future. And it's right here in the forward guidance for 2026 that we start to find the clues for the market's hesitation.
Management laid out their targets for the full year. Loan and deposit growth look modest, achievable. But the key number on this slide, the one the market obsessed over, is that net interest margin forecast of 3.4% to 3.5%.
And here's the crucial context, straight from the CFO himself. That optimistic NIM guidance, it is explicitly built on the assumption of 2 Fed rate cuts in 2026. This ties the bank's core profitability directly to a very specific Fed path, and that introduces a big variable for investors. And just to add another layer to it all, they also announced that their long-tenured CFO, the guy who just delivered that guidance, is retiring. Now, a successor has already been named, but any C-suite transition, especially in the CFO role, is a soft catalyst that just makes investors pause and think twice. So, the formal presentation was all positive, but the analyst Q&A session, well, that's where the real pressure testing happens. And the questions that were asked revealed the market's underlying anxieties. Before we get into those questions, let's quickly define a key term you're going to hear: deposit beta. In simple terms, it just measures how much a bank has to change its deposit rates when the Fed changes its rates. It's a critical factor in a shifting rate environment like this one. So the analysts, they zeroed in on the biggest risks. They repeatedly questioned the assumptions behind the bank's deposit costs. You could almost hear the skepticism. They highlighted the intense competition Cathay faces in its core markets like LA and New York. The questions themselves painted a picture of a tough operating environment ahead. Okay, so what do we have? We've got solid execution set against future uncertainty. How do we put this all together? Well, that brings us to our final section, the next call. Look, the bull case is clear. The bank is executing well right now. Margins are expanding, credit is clean, and they're buying back stock. But the bear case, well, that's what the market priced in. That guidance is sensitive to Fed action. Competition could squeeze margins, and there's a real risk they might not hit those optimistic targets. So, how do we see this playing out? We'll break our view down into 3 parts: our prediction for next quarter, the expected stock reaction, and our final rating.
For the first quarter of 2026, we expect Cathay to deliver results that are largely in line with expectations. The headline numbers won't be the real story. The entire focus is going to be on whether they can maintain that net interest margin. Because of this, we expect the stock to be pretty much range-bound, just treading water until the market sees some hard proof.
This leads us to our final reading, market perform. Now, this isn't a negative call on the company. They're running the bank well. It's a reflection of the stock's current reality. The good news from Q4 is already priced in, and those forward-looking risks are now acting as a ceiling until management can prove its 2026 guidance is not just a forecast, but a reality. And that leaves us with the ultimate question investors need to watch. Was this strong quarter the peak, fueled by a unique moment in the rate cycle? Or can management successfully defend their profitability against fierce competition as the Fed begins to cut? The answer to that will determine the stock's path for the rest of the year. And as always, just a reminder that this content is for informational purposes only. This is not financial advice.